Pretty numbers can also tell an ugly story once you dig into it. There is no way I would do all of my own due diligence on my property. Like, I've got a team that they're way more tuned and they've got the processes set up to get the information quickly. One call can change the whole deal.
Is your DD, is it unique to Rethink? Like, is that your IP?
Yeah, because we've done 5,000 plus deals and, we're always adding to it. Acquisitions and due diligence are two of my favourite parts of the business because one's finding the product and two is checking the product safe. You need those two acting independently.
What do you look for in a good DD person? Are they sort of mathematically orientated or, no doubt they're probably good with jigsaw puzzles, I would imagine?
So due diligence, I always say, is on salary. So they're not incentivized to get a deal through. Their incentive is to do a good job. Our acquisitions people are set up as commission. So they're obviously finding deals, they're hungry, they need to get a good one that they know a client will like. You'd never incentivize due diligence to get a deal through.
G'day, how you going? Phil Tarrant, co-host of Inside Commercial Property with Scott O'Neill over the Rethink Group. Back in the studio, just us this time around. No guests, just the OGs of this podcast, episode 66 of Inside Commercial Property. Scott, how you going?
Good, mate.
Yeah.
Good to be just you and I.
I know.
Get deep into the commercial stuff again.
It's pretty good, mates, and we're certainly running into summer and the end of the year, but I know that you haven't lost your holiday stubble yet. Is this a new look, is it?
Oh, I think so, for now.
Yeah. See how it goes. What's going on? So two months till sort of everything shuts down. People are already putting their feet up and taking it easy, or you guys stuck into it?
Oh, it's crazy. The market is as strong as I've seen since 2022. So that was kind of I guess just before the interest rate started going up, and we were seeing record volumes, highest yields out there because people were just paying so much. And then obviously things softened after that. But it feels like we're going back into that type of market. There's just considerable amount of buyers. Like, as a company, we did 190 mil in transactions last month, which is our largest ever. Second largest was 180, and we're normally doing half that this time last year. So something's changing, and it's the volume of buyers. There's enough stock out there to, I guess, buy at the right yield and quality. So yeah, I'm quite bullish where it's going. And I was actually just reviewing some of the figures. I think we mentioned in a podcast, what would be the number one asset class, and I sort of came up with large format retail, which was a bit controversial because everyone's thinking industrial. And just checking the figures through CBRE, we're sitting at 15% growth for the last 12 months for New South Wales assets, and WA is similar, and the rental growth rates are considerable. So I guess the rent growth in large format retail is beating industrial, easily beating the likes of office and stuff like that. So what's that telling me? It's people are kind of benefiting, or consumer sentiment is quite high due to the thought of rates coming down further. So people are spending on household goods. We're still in a theme where builders aren't building as much as maybe that asset class could deal with because the margins aren't there. So yeah, it's just strong market, not much supply. Money's getting cheaper. Times are good.
So quite a lot there. Just to pick up in terms of your numbers, twice the volume than say this time last year. Is that twice as many clients, or is that the price point must be going up quite a lot? I imagine the average price point.
It's a bit of both. So our average deal size has not doubled. So it's probably half of that increase, and then the volume is increasing as well. Okay. We are finding decent cheaper deals out there. As you know, we're so adamant in this podcast, under 1.5 mil is hard. And we need to tell the market that, because you've got every other individual encouraging you now to get into commercial in that lower end of the market. And it's just getting harder. I was actually did a bit of market research. A few of the agents I know quite well, just called around the country. Who you're seeing in the market, what's out there. And it's mostly individuals trying to buy themselves in those lower price points. Okay. There's no real prominent buyer's agent out there that represents that because the numbers aren't stacking up, and there's just so much demand that they outnumber the buyer's agents considerably. Above 1.5, it's buyer's agents are considerable out there, and that's where obviously we do all our work, or most of it. But yeah, they're buying things lower yields that the agents are shaking their head at. They're thinking, this is 20, 30% above market rate, but someone's willing to pay it. And they sort of kind of giggle to themselves going, yeah, look, you could never recommend that, but they're happy to pay it.
Or if they happen to pay, and it sort of lends itself to what I really want to hone in today is around due diligence, right? And whether or not you're buying sub 1.5 or elsewhere. But I'll just park that for a moment. So picking up the large format retail, and I remember the conversation we had around that, and when we always sort of look at different asset classes, is large format retail out of the sort of grasp or the realms of most commercial property investors? Because when you think of that, you think of these large super centres and stuff, and you go, you got to be insto play to be in there.
Look, the big stuff is 100 mil plus type stuff, but you can buy them individually. There's a lot of super cheap autos to beacon lightings to all those ones you see on those main road industrial, quasi type commercial zones. They can all be bought individually in many cases, and it's a function of size. If it's a small, large format retail centre, it could be 300 square metres. You can get that cheap per square metre, but a lot of it's 1,500 square metres plus. So do the math. It turns you over 3 mil in most cases. So, if you got 3 mil to spend or more, you can look at that asset class. It's a good asset class because they got ASX listed tenants, long leases. They're protected from the fact they've got high traffic plus a bit of a warehouse type feel. So storage and high traffic tend to go well together. And in this current market, it's doing quite well because costs a lot to build these things too. So the threat of new supply is not as much as a threat as other asset classes.
And you say that it's expensive to build. I was looking at some numbers today around resi building approvals, and I think we're sort of 10% off the 5-year average. So we're actually, approvals coming through is lower today than what it has been over the average of the 5-year period. Well, what are you seeing in commercial? Are we seeing sort of building approvals coming through sort of at a more sort of vibrant rate, or is it a bit subdued as well?
It's increasing in industrial. So there is a lot more supply coming on, probably the most we've seen in a number of years. And looking at the stats, about 50% of that stock is pre-committed. So 50% has no tenant. It's just built speculative stock is what they would call that. So that's getting higher. The result of that is slowing growth rates for industrial. So we're the slowest growth rate for industrial rents in the last 5 years. So still growing, probably on average about 3 to 4% across the country. But some markets are not growing, such as Victoria. Some are kind of, doing a bit better than others, like New South Wales, and WA is still doing okay. But there is a slowing trend, and that will probably continue. So my message there is industrial is still a good asset class, but the heyday of rapid growth for rents and industrial values are slowing up for sure.
So is that happening somewhere else, or is that overall the market is in a steady as she go type of equilibrium?
Well, it never moves at once, so there's voids in the office market still. But look, office in suburban retail or those fringe areas are still doing quite well because there's supply. But CBD office, a floor plate in the city is your weakest market. Retail is gaining a lot of the strengths as consumer sentiment increases relative to how it has been. And then you've got, everything in between, like medical to childcare is pretty popular again at the moment. Even servos are getting a little bit of a resurgence at the moment because everyone's seen the take-up of electricity or electric vehicles rather have slowed up, and maybe fuel stations are going to be around a bit longer and become battery stations in time. Who cares? So
I find it hard to find petrol stations these days. There seems to be a lot less than what there used to be sort of 10, 15 years ago. Maybe that's just where I'm going looking for petrol, but there just seems a lot lighter on the ground. A
lot have been closed and big brands have taken over, like the little independents, but the yields are better in that asset class too. So, if you're confident that, you can ride out 15 years of rent coming in, maybe it's a good site after, minus the make good of the site, that could be an asset class to consider, even though we've always said don't look at it. But we never liked it too because the yields were so off. Like there were people buying 4% yielding service stations in average areas just because of the lease. And now that same asset could be bought at 6% in many cases. So all of a sudden, as a value investor, you take a double take at it.
And you mentioned doing a bit of a sort of straw poll with agents across the nation, and they said sub 1.5 is a lot of DIY type operators, people doing it themselves versus maybe people leveraging a buyer's agent. What do you think's driving that? Obviously, they're all tuning into this podcast and sort of going out and giving it a crack themselves, but to have that many people operating in that sort of bracket without using professional support And it sounds as though buying at yields which most agents would think were a bit sort of how's it going? Like, what's driving that?
Look, we are a part of that for sure. Like we have 6-month waiting lists in that price point, sometimes longer, sometimes shorter, depending on, the extreme of their budget. But it is a point where someone's like, I'm not going to wait 6 months. I'm going to go talk to another buyer's agent, and they'll they should be saying a similar number because it's the same stock. We're not all playing with different countries and markets here. It's the same pool of properties. And, we've arguably got by far the best contact base because sheer volume and the amount of work we do with the same agents. So there's no shortcuts other than pay more. And that's unfortunately what is happening, and agents all over the country recognise that. And it's a problem out there for these investors. But they sometimes just compare the yields they're getting in residential and go, look, that's okay.
Better than what I'm getting.
5% net's okay, but really it's a 6% net market, so they've paid 20% over. Some don't even care.
But imagine most of those buyers sub 1.5 will be leveraged, right? They're not buying with cash.
Exactly, yeah. So, and that comes down to the education piece. Like they will listen to what the agent says, or, see that a vacant property sold at a certain number and then price it off that. And this is kind of the point of this podcast, just to go back to basics, look at due diligence. How can we help those, because, as you know, we've got an inside residential property of the podcast, and there's 2 reasons for that. One, just to remind everyone, we're still very large in residential and we love that asset class. But the other is there's just no reason a lot of people should be going into commercial. If they're playing in a space which is going to give them more risk than reward, then residential, as you and everyone else who has listened to any podcast on property knows how good residential can be, you just got to sacrifice cash flow for that. So we're just kind of pointing them back to the basics and go, don't blow it on the wrong deal in commercial. Consider resi for a bit longer.
And this is the point, right? You graduate into commercial property rather than probably use it as accelerator to start and build out your portfolio. So it's good to see you doing it, and you can tune into Inside Residential Property on the
same as this
Property Investment Podcast Network, where you're tuning into this as well. So I highly encourage you to go and do it. But the thrust of this podcast is really due diligence for commercial property. So like a 101 approach. And for those of you that didn't go to university, a 101 is typically the introductory course. You would have done engineering 101 or something or other, no doubt. Fluid dynamics 101. What are you, structural engineer?
How do you know about all that? Being the journalist.
I don't know. I just pick up information along the way. But I've done some 101 courses before.
Yeah. No, I still got those books at home. I looked at them the other day going, God, I can't remember any of this. Like these equations that go for 2 or 3 pages, and it's a bit
frustrating though when you look and just go, I used to be able to do that, and now I just got no idea. I look and it looks foreign to me. I was an engineer, by the way, but
it's probably like year 12 mathematics now, though. Who knows?
It's crazy. You've
got to start tutoring that again to your kids. It's hopefully you learn it quick.
But getting back to basics on due diligence, and this is specifically probably targeted at those people who may not be using a buyer's agent. Obviously, I use buyer's agents, but in terms of due diligence, the more connected and the more affair you are with it means you can interrogate your buyer's agent a lot more. So I'd encourage you just not to assume due diligence is being done in the background, even though if you're paying for the service, if you're a property investor or a commercial property investor and you are actually using professionals to do this, they would probably rather you be informed than just sort of sit there and just go, whatever you think is the right thing to do. You probably don't like that, do you, too much? I sit there and just go, I'm at that point now where I go, I'll probably do this myself. But then the voice of reason and sensibility sits in, and someone like you would say, well, is that really what you should be doing with your time, Phil? And that's pretty much how it sits for a lot of people, I would imagine.
Oh, even for myself, there is no way I would do all of my own due diligence on my property. Like I've got a team that they're way more tuned and they've got the processes set up to get the information quickly. And that's a big part of it. Like you generally work with 21 days max for due diligence. And if you don't know exactly what to ask up front, you're not going to get it all in time. And in a competitive market, you simply will be working it out as you go. And even if you're an absolute genius, it's going to take time and go like, there's another question. Each week goes past and all of a sudden the agent's got a line of 5 backup buyers and you ask for a week extension. It's going to cost you. You either lose the deal or you're going to have to put a non-refundable deposit down, or there's always ways to keep a deal going.
Yeah. So I wanted to find what DD is, but before I do that, it's more of a conceptual point. Is your DD what you guys do, is it unique to Rethink? Like, is that your IP? Like, is that the competitive advantage for Rethink? Is that your DD process? Obviously, you got to find a place, and once you found a place, it goes into a sequence of assessing the feasibility of the purchase. Is that like the secret herbs and spices for Rethink there?
Yeah, I think so, because we've done 5,000 plus deals, and we're always adding to it every year. So it's just like research on research, and then just make it a better report. Like, I know a lot of others in the industry have based entire businesses off what we've done in the due diligence, and it's probably my favorite part. Well, acquisitions and due diligence are two of my favorite parts of the business, because one's finding the product and two is checking the product's safe.
Yeah.
And you need those two acting independently, which they do. So they're, by the time they've gone through it, it's a good deal. And this is why we've been in 10 years, and, we've basically done a good job for clients, and we've grown to the largest, not because of anything other than the product's good, and you need that, because you will get found out very quickly in this industry if you start pushing bad deals through, or ones that don't grow, or where the tenants are all leaving, or you're buying too much vacant stock, and it'll bite you. And it is a high risk asset class, and we don't want people to forget that.
Yeah, a lot of dough going into it. And sort of pick up that point. So you have a firewall between acquisition and DD, so different teams doing it. So imagine there's some sort of transfer of knowledge at some point, but so you structurally keep the two separate.
Yeah. So due diligence, I would say, is on salary. So they're not incentivized to get a deal through. Their incentive is to do a good job. Our acquisitions people are set up as commission. So they're obviously finding deals. They're hungry. They need to get a good one that they know a client will like. But yeah, you'd never incentivize due diligence to get a deal through, because that clouds things.
Yeah. And the psychology for that team, or what you instill with them, is it find a reason for this deal not to take place, or you tell me the reasons to do this deal?
Yeah, like, so worst case scenario is, like, let's say 12 months later, a tenant's left, and client might be going, oh, why didn't you pick it up? Did you sell me a dud? It's happened a handful of times. And this is due to a million different reasons. Like, sometimes, like, even one of my properties, a husband and wife team in an IGA got divorced. They just shut the door. So there's, like, unless there was paperwork already out there that was public knowledge, or I talked about the neighbour and he mentioned the wife and husband were fighting, like, and then maybe I could assume they'll shut the business. Like, you can't do that. So you have to really just take into context what happened at the time. But you would never want a bad deal to go through, because the time invested to fix it is way more than whatever benefit a company is going to get out of a commission payment. So, cancelling a bad deal is great. It's a dodged bullet.
And no doubt, so if you look at your acquisition team versus your sort of DD team, they're different characters, I would imagine. Like, what do you look for in a good DD person that's sitting at the assessment side of things? Are they sort of mathematically orientated, or no doubt they're probably good with jigsaw puzzles, I would imagine?
Yeah, well, they look detail orientated, but there's got to be a splash of common sense in there. So it's not just learning a process and following the process, because, like, you got to think outside of the box. Like, just name any type of commercial property, it's going to have its own unique circumstance. Like, I always use the childcare one. Like, you got to look into the 0 to 4 year age groups in that, suburb, and look how many placements there are, and are there new DAs coming up. That's a totally different process to an office space, which might be premium in nature, and there's, it's got the best cafe in the entire area, and there's, extra car parks there. So maybe that will stand out a lot more than others, which means you can charge a higher rent. So on paper, the rent might look like it's inflated, but there's reasons for it. And that's a big thing that comes up. How can you value the rent? There's an art to that. And that's sort of where experience in DD or due diligence really kind of comes into its own.
We should probably define DD, because just listening to you there, I'd say a lot of that is really the acquisition side rather than the DD side. The acquisition people are there to find the opportunity and see the upside and buying value. And I imagine your DD is the checks and balances, or do you expect them to actually uncover that as well?
It's both. Yeah. So you rightly said acquisition has to have that. So we train our acquisitions people to never show a deal unless you've got the comparable rents, because that's the first way to check an easy risk item. Is the rent inflated? And if it's not, then the yield's at the fair rate, because a lot of the time, rents can be overcooked or undercooked, which means there's upside as well. And then if there's upside, we've got to then quantify it. The due diligence is there to verify everything. They, the pretty numbers can also tell an ugly story once you dig into it. Like the yield might be very high and you think, all right, well, that's above average yield for that market. And then you go into it and there's a large incentive in the lease that's done as a fit out contribution, which has pumped the rent up because it's amortized into it. And you've got to understand, once you take that out of it, is it really where the market is? And then you compare that new yield to the average yield. Like, it's just verifying what you already know a lot of the time. And then hopefully you don't find any booby traps in it as well.
Yeah, and that's what you want to try and uncover. But again, it's a philosophical thing, right? If your acquisition people find upside potential in an asset that suits the brief of a client, you just don't want your DD or your assessment team to just have a bias, which is like, oh, we'll overlook that because we know that this is the case. So what would you expect from due diligence? Is it a sort of like, is it a document? Is it a verbal thing? Like what does it look like? What does it smell like?
So we've got a large checklist, like about 120 points. Some are more focused towards like office, retail, industrial. So they all vary. They peel off for the asset class. And there is a lot of just ticking boxes in there, but there's also the point where, like, we tell them to make phone calls. So one call can change the whole deal. An example is we saw an IGA for sale, put it under due diligence because the yield was good. They called up Metcash, which is the supplier for the goods for a lot of the IGAs at the time. And that call was pretty bad. They said, yeah, it's one of our worst performing IGAs. And that was enough to crash the deal.
Do they need to tell you that though? Like, is there
No. So you got to play the game a bit. Like there's a lot of information you sometimes are not meant to know, but you've got to work around that.
If you're a good sleuth and a good communicator, you can largely get a lot of intelligence.
And I remember that deal. It was in Townsville, and there was a few other red flags. There was so many other centres around there, and it was a bit quiet. So you can kind of tell things just by seeing car parks ratios and other tenants, how they're performing. But that tenant lasted 18 months and they're gone now. So I actually met someone who bought that property and their plan is to turn it into a large format retail. So if you got a passive investor into that deal, that would have really, like, if they had no cash reserves, that could have blown them up because they might have to spend millions on it to rebuild the property to suit a large format retail tenant plus the vacancy. It was a big deal. We're talking 10 mil type stuff. And, even a small variance here or there could be 1 to 2 million. So, again, one call can change everything. So they've got to be following checklists, but also thinking on their feet. And that's a random example of that.
And do you have like a head of DD at Rethink that has a team underneath? How do you organise the team so you get the right outcomes?
Look, we don't. They're like a community, so they catch up all the time, share best practices. Like we add things to lists. Like we do due diligence in New Zealand, so there was a huge learning curve there in terms of. We actually hired external consultants for we've been over a year there now. Found out exactly what they do. These are $20,000 report type things just for DD only, and found out that they're not doing as much DD as we are. They just got bigger pamphlets a lot of the time. So we thought, all right, we'll bring that back in-house and use local lawyers to check certain things like, anything to do with earthquakes, the seismic issues, and their different building codes and different council regulations. It's all pretty similar. And, you just got to share in between the team and develop the process monthly almost.
So you got to trust the process. Absolutely. You don't deviate from the process, follow the process. And by doing that, you'll probably uncover stuff that.
Exactly. And it's about a 10% crash rate, I think. Okay. So 5 to 10%, depending on the market. But that's come down a lot. Like I remember in the early days, it was a lot more because you had valuations not stacking. When the market was rapidly growing, you get punished a lot more by delayed data. And we're trying to kind of act in the current market, but versing it against 6 months or sometimes earlier because there's not that many supermarkets or large retail, whatever selling in that same market. So that can be a trick, and that'll probably arise in the near future again because values are growing.
So DD is an evaluation report though.
No, but it's similar. Like we have to verify the outgoing. So one of the most important things they do is check every single number on the deal. Then like it's almost 3 columns. You have what the lease says, that's column A, what is actually happening, and then there's also another column which could be what the potential is as well. So you can compare all three, and they're all three different numbers. So valuers just look at the leases. They're often not looking at what's been paid.
And leases can be murky. And we'll sort of break that down a little bit further. But in terms of DD then, so the process is pretty broad and general. So it includes all aspects of it. So do lawyers do DD, or are they sort of analysts, or, I imagine there's different aspects done by different people?
Yeah. So to sort of start from the start, you put a property under contract, subject to due diligence. Always do that. Never. That's why we don't go to auctions. I find that just way too risky.
Never
it's
buy
all in
an
the
auction. No.
Never.
Very
What's the
occasionally.
point?
No.
Like, you're just going to get held over a barrel at a price, and then hopefully everything stacks up well. The odds, agents will say, "Oh yeah, do your due diligence up front," but I'm not going to do that for a 1 in 10 shot of buying it, or even 1 out of 2. I want to have control of that asset, because due diligence can cost thousands, if not tens of thousands, to do. If you get a building and pest report, which could be minimum $3,000 for a big deal, and then you've got to get all your lawyers through, like you could be spending $10,000 on lawyers plus, and then everything else in between, aircon specialists.
So I guess that's the key thing now in resi sort of auction environment. You do a pest and building, and that's largely the asset. There's not going to be anything too curly in there in leases and stuff. But commercial, this is your point around, whether or not you should be a commercial investor or a resi investor. There's a lot more risk involved because of these other nuances of the deal.
Exactly. So first way to reduce the risk is use a solicitor, never a conveyancer. And the context of this comment is, over the years I've had hundreds of clients say, "Can I use my local conveyancer because she's $1,500 or $1,200?" It's like, well, no, because they can't legally look into lease reviews. They can't handle disputes when they happen. There's disputes during the contract process, after the contract process. I'm going through a legal process at the moment just with, it's something to do with rental agreements, rental guarantees. Like, there's dispute over that, like how it was set up and what's paid and what's not. Like, it's complicated. So solicitors will cost more, but they will save you more in the long run, because you'll know exactly what you're doing. And even things like GST, stamp duty regulations, like they're different in every state. Like, you must have a really high quality lawyer. And we will do a podcast on this, because this is a whole topic on itself. It's its own due diligence. So credit checks on tenants. You can go deep.
So is that legal DD? That's so two aspects of it is whether or not the feasibility of the asset itself for the purpose of why you're buying it, and then there's the legality around it. So you have a legal team that does all that aspect of it. Yeah.
There's a vague overlap between the two. So we obviously have to read the leases, because we've got to know which outgoings are paid and whatnot. But leases can contradict each other. Like, sometimes there's make good provisions in there that an average person would never understand. So we need a lawyer to interpret it and understand, well, if that tenant leaves, what's the cost there? A lawyer's not going to tell you if the property is financially viable. No chance. Like, they will just tell you this is what you're getting and this is your risk, but they're not going to tell you, you've got a chance of making a good return on this at all.
It's not the lawyer's job to do that. But what it would say about property lawyers, it's not all property lawyers are created equal either, where they miss the mark so many times, where you just think, oh, well, they're a lawyer, therefore they know what to look for. There's a whole bunch of things involved in this when you're buying commercial property, particularly around leases, that if you don't know potentially where the bodies are buried, you don't know where to go looking for them. And I tell you, in commercial leases.
Oh, exactly.
Yeah.
Imagine you're up against like a Woolworths lease. They've got a standard legal team that documents or creates their leases for themselves over the country. So you've got no chance if you're not lawyering up as well against that. So you need to understand it, because there's things like turnover bonuses and fees in there, like caps in leases, like even just understanding CPI, like sometimes it's CPI based on a state or an asset class, or again, it's complicated, but it's not when it's all summarized for you. So get the lawyer, and then obviously a good due diligence team around you. By the time that due diligence is over, you'll understand that asset better than the owner themselves easily, because they don't know what's going on. Like, I don't even know what's going on with a lot of my properties these days to the decimal point, but I did when I bought them. So you just kind of then let them sit and forget, and hopefully the property managers are doing their thing. But the gap widens in knowledge, and that's where, a lot of them look to sell, but they haven't spent a lot of money. So even a building and pest report will show so much more detail than they're aware of. Like it's like getting a building and pest report on your house where you live now. Like, there's cracks you probably would notice day to day, but the buyer will, So then you've got to adjust expectations, discount. Again, lawyers and DD teams are the only way to get through that.
And how much of the DD process is around justifying the deal that you've set with the agent or the vendor, and or leveraging the DD process to change or shape the nature of the contract negotiation? So it could be price or terms.
So our ideal world is there's no changes. Unfortunately, it's very rare that happens. Like we've even been branded by agents around the country, the Rethink discount, because there's a discount at the time because we've found variations in the lease. And we don't like that brand at all, because we're not trying to get a discount. We just want the fair yield given back to us. And sometimes they've just said, land tax is payable by the tenant, but it's not. And then we've got to take out 14 grand off the annual outgoings, and that's going to reduce the yield. So naturally, we want to reverse yield that back into the price. So that can be a pretty significant discount depending on the cap rate, 100,000 plus. And a lot of them just don't understand that. So, sometimes we've got a commercial decision that, we need 100 grand discount to get our initial yield back, but the vendor's saying, 20 max. And then we've got to talk to our client and go, look, they've come back at 20. Should we crash the deal? And they go, look, get us 50 and maybe we'll do it. And then we'll go back. And, it's a deal making scenario, but that's all extra work. It's due to a flaw in the disclosed information at the time. Maybe the lawyers picked up something that their lawyer didn't. Again, due diligence pays for itself in those cases, so it's not all bad. And even our whole buyer's agent fee can be covered, in a way, if you look at it that way, by just discounting the price due to building and pest items. It's all real world stuff.
How do you balance that with competition with commercial property and the fact that there is a whole bunch of buyers agents out there now concentrating commercial, but more importantly, there's a whole bunch of commercial investors doing it themselves. Agents get to a point where they go, I know if I'm going to be dealing with that person, it's going to be a much harder deal, which I hear from some agents now around buyers agents. They go, I'd just rather go direct to a DIY top rope, because they just don't have the same stringent sort of due diligence around it.
Yeah. Or in preparation for this podcast, I actually called around a bunch of agents last week, and the feedback is all the ones that understand and are detail orientated actually prefer working with us, because we've got a checklist. We've got a standardized email that comes through, and they're already they're aware of it. So they can get it all done in 2 or 3 days. It's ones that are just used to selling to owner occupiers who do no checks, like the old school red brick warehouses in Sydney, and they just expect to sell it on a square metre rate. They don't understand what a legal mezzanine is, or why we want to get a certain cap rate. They just can't get their head around it. So you just don't work with those ones, and they'll just keep selling to owner occupiers mostly. There's a lot of negative feedback on the buyer's agent industry with inexperienced operators just crashing on deals because they get they'll convince a client onto a deal, and the clients talk themselves out of the deal because the buyer's agent will keep trying to talk them into, unless there's something significantly wrong with it, which hopefully ethically they're going to cancel the deal themselves for the client and just let them ride the process out. But just knowing the process it gives us a better rep in most cases. It's got better over the years as well, because I remember when we first entered Victoria and started talking about minimum yields, and we needed prove things and leases that included tax. They'd say net. And I'm like, is that net of land tax? Is net of property management? And they'd be like, no. So don't use the word net. That's a fake. No, that's gross. It's semi-gross if you want to be specific. So just the education process typically means a better outcome for everyone, less angst, less stress. Yeah, better outcomes for everyone. But to the point you were making around, like land tax and whether or not it's included or not, do you assume 100% of the outgoing liabilities when you do assessments for your buyers? Yes, the tenant, depending on the lease, will covering some or all of them. But do you assume 100% of that when you look at sort of yield positions? So yield's always got to be back calculated off. We do a single holding of a company or a trust structure for land tax. Property management's in there. Like, we know the rates. It's different for different markets. It can be as low. Property management can be as low as 2%, all the way up to 5-6% for commercial, depending on the size and the state. You can get fixed property management fees, which again should be documented through previous management in deals. But yeah, we have to obtain the leases and verify all that too, because every lease is different. Some are retail act leases, some you can't charge for land tax, but that's fine. We still calculate it back to a net basis. I don't care who pays for it. It's just got to be accounted for, and the net figure is the net figure.
So you're better off being super conservative and trading on the upsides rather than the other way around.
Always, yeah. We even started to put buffers in place because we know because we're sick of having to negotiate against deals where they've just forgotten garbage collection or something where it's a centre.
Do they forget, or they deliberately forget, or a bit of both sometimes?
The ones
they expect you to find it?
Yeah, good question. So the ones that sell to institutional guys, or companies rather, are basically always going to include everything from waste management to common area power fees to, recycling, whatever. It's all in there, gardening. If you're selling to mums and dads, take that out. There was a deal we saw in Regent's Park where it was an inexperienced agent from one of the big auction houses, and they just showed the only outgoings they had in there were land tax, but it was the wrong land tax. It was broken up into 2 6-month periods, so they just included 6 months only. So half they're missing. There was no rental management. There was no maintenance allowance. There was nothing to do with waste management, which was a large cost as well. There was a sewerage cost. And basically it was about 40, 50 grand per annum missing. And we've unfortunately found out that during the DD and had to crash on the deal, and someone else bought it at a lower yield. Good luck to them. But
that's what you're doing, just buying a lower yield.
Yeah, and you just got to be happy to accept it. But, that yield was into the 4%, for Brisbane, a year or two ago. So, there's no upside in that.
So to the point around, say you negotiate a price, you in principle would like that to remain the deal structure all the way through the DD process. However, if you uncover stuff through that process, when you look to reorientate the price down, whether you're buying or selling, once you start down a process, you want everything to be accurate and factual, because when you start uncovering stuff is when you typically go, well, there's more to uncover, rather than being a very prepared vendor. And we haven't done a lot on selling stuff. It's always been about buying stuff. If you have absolute transparency in your paperwork from the absolute get-go and provide that information with nothing hidden, you can typically navigate a much better deal outcome for everyone involved.
For sure.
But typically a lot of people don't like to do that.
No, but
they try and get one up on you, if you want to call it that.
Yeah. And I think when you go into a new market, they struggle with that. But like I said before, we've got about a 5 to 10% crash rate, so super high. So agents know once we're under contract, because we've asked so many questions up front, it's probably going to settle. So they get addicted to that because there is a lot of crashing out there, especially in the buyer's agent industry, because like I said, their clients themselves will crash because they're maybe being pushed. We'd like to have 20% buffers in there in terms of the client can spend a bit more, or sometimes they're working with our finance team. So the finance team looks at the deal first and just verifies, it's all okay. And then, you're not to the wire at that point. And then you can actually buy with a bit more confidence. But the more changes, the more stressful it is, the worse it is from a customer service point of view, the worse it is for us in terms of time management. It just gets uglier when things are missed. So, we love a clean deal. Yeah.
What structural exits do you put into any DD process?
Yeah, there's two. So you got an all-encompassing due diligence clause. So again, you have a fully qualified solicitor document that for you, because due diligence can be restrictive to certain things like maintenance over a certain amount, or you don't want a restrictive due diligence clause because then you can be trapped. The other one is finance. Finance, we all know it from the resi side of things. It's just got to be pretty open-ended finance one. If it's crashed, using the word satisfactory finance is a good one, because, even if your interest rate's too high, it's not satisfactory there, or the valves come in way under, that's finance, or due diligence, depending on how you look at it. So you've got two ways to exit. And then even when you close due diligence off, you can still leave items open. So, for example, subject to viewing air-conditioned reports, because we're worried there's a big blowout there, but we haven't had time to get it because we're waiting on an external contract to get down there. This is where the experience of a team will help, because we've got the contacts to then get people through, and you're not rushed into doing a deal. And if you are, because there's 3 buyers lined up, there's ways around that if you know how to, skin the deal properly.
And would you put them into a sort of commercial, like in a commercial negotiation for CP's condition precedents? Like, can you actually layer them into any sort of DD process or gives you these exits over and above your sort of general finance stuff?
Yeah.
Does that annoy the agents to put that stuff in when you start layering all those what ifs?
It does, but again, we're acting in good faith. Like, we all want the deal to settle if it's a good deal. If not, we're like the first to crash it because it's resources we're just putting into a what if or dead deal. So it'll be for a fair reason, and there's never really pushback. At that point, you're really just dealing with like egos of lawyers. At that point, going,
lawyers don't have egos.
That. And that there is. Luckily for us, it's pretty good out there in terms of the commercial side. Like, it can get ugly, but I don't remember that many cases these days because the agent can talk to the lawyers, or the agent talks to the vendor and says, sort your lawyer out, they've been unreasonable. We'd do the same and say, look, let's be commercial here. We need to get this to a fair outcome. We're just wasting time being unreasonable. And
typically, if investor people want the deal to get done because everyone's sort of wasting time. When can the vendor sort of once you've inked contracts and you're down this pathway where you've entered DD, when can the vendor pull out of the deal?
Only if you breach the contract. So there's a couple of ways to breach a contract. You might not pay the deposit in time. You might be over your allotted due diligence period by a day. Sometimes it's like an instant crash contract. Sometimes it assumes if you don't say anything, the contract just goes unconditional. So you've got to be very careful there. I've seen that happen with external lawyers too, where like the clients wanted an extension, but now the time lapsed because they sent an email at 5:02 and 5 p.m. was the time. And then that causes huge issues. Lawyers can get sued for that.
They can do. Yeah.
So it's a bit of a minefield, but that's again the legal representative's job to manage all that, and they do it very well. But the vendor can, I've seen them try to crash development ones where, you're 1 day late, and because the prices of developments have gone up since it was built,
they'll find a reason why to crash
instantly.
It. Yeah,
and they can take your deposits in that period too.
There you go. So make sure you have a right lawyer on your side. So there's lots of moving parts to DD, particularly those trying to do it themselves and maybe using a sort of suburban conveyance. So I'd say sort of, it's probably fraught with danger. You need to make sure you get this right. But where most of the DD takes place is probably around sort of tenant analysis or leases. How much energy and effort goes into sort of lease assessment? Because unlike resi purchases where there's quite standardised contracts irrespective of the state that you're buying in, they can be very different commercial leases, and pretty much they can be whatever you want them to be.
Yeah, for sure. Well, I thought to answer your question, I'll go through a few of the points we look at really quickly because I don't want it to just read out checklist type stuff. But, obviously you've got to get the tenants' leases, and there's sometimes variations of the lease as well. So you've got to get all variations, and
because all variations will go back to one base lease, and that might even be 10 years old.
Yeah,
and it just might be variations over.
And how many? What was it? 3% annually? Was it 4%? Was it CPI with a cap? You got to really go through it. So then you actually verify the exact amount of rent you're getting. So you've got to get tenant ledgers. So tenant ledgers is the other thing. Then you confirm the rental amounts versus the payment terms and versus the leases as well. You and your lawyer should then sit down and look at the rent reviews or the due diligence team. Like I mentioned, is it fixed? Is it market rate? Sometimes there's mid-market increases to where it kind of balance out where the market is, sometimes end of the lease, but your rent might go up 3%, 3%, 3%, then the market rate hits and it could be 12% because the market of industrial has gone up a lot in that time. So calculating that, then you've got to get access to the security, deposits, bank guarantees, all of that. Verify the outgoings. This is what we're just talking about, just checking the balance sheets, the numbers. Look at invoices, the gardening costs or the maintenance bill. You don't want to put maintenance in there as whatever last year is moving forward because they might have replaced a roof or fixed the gutters around the property. So you've got to have common sense there and say, look, maybe I'll just annually say there's $5,000 in there. That's open to interpretation, but it does affect the yield a lot. You got to check option periods and terms. I had a client or a broker the other day crashed on a deal because there was no options, which I couldn't get my head around because options only favour the tenant. But they really wanted options for some reason. So that just showed they didn't really understand.
So he wanted the continuity of the tenancy rather than sort of potentially sitting there vacant.
Yeah, and like my strategy with that would be wait for the tenant to kind of get to the week before it expires and go, look, your fit out's there, your business is going strong. Can we have the property back?
Yeah.
And destroy their business. You don't want that, but then they'll go, oh shit, all right, better renegotiate. But they're not going to have the power they would if they had 12 months leading up. So being a bit unpredictable there will help you as a negotiator, but then you have all your ducks lined up, know exactly what the square metre rate is. You can then show the tenant, hey, look, here's what your neighbour's paying, here's what 10 other similar cafes or whatever are paying in the area similar to you. We're not going to charge you the top rate, we'll charge you the middle. Is that fair? 5-year lease, how about it? Talk to your lawyer, we'll sort it out that way. And you might get a benefit out of that, you may not, but either way, I don't know why you need options that only favour them because it's a fixed amount, unless the market's dropped considerably.
Yeah.
Because then it fixes you at a higher rate, but that's not great either because the tenant will struggle. Review, break, lease clauses and conditions. So one of the questions I always asked when I was doing any analysis on a property is, are there any break lease clauses in there? Just ask the agent direct because then they're on record for stating that. Like you could have a 15-year lease, but I've seen one where the tenant can give 3 months notice and they're out. Maybe they're government funded every 3 years or whatever they can get out, depending on what's going on with payouts. But make good obligations are a tricky one. Rental guarantees, abatements, like I'm dealing like that, and the legal issue there. Calculating the weighted average lease expiry is a big one for your finance team. So you might have 6 leases, half a 1-year lease left, half a 2 years. So the average is 1.5.
So this portfolio de-risking on a whale, is it?
Yeah. So it's average weighted lease expiry. So it just shows how much rent is going to come in on average, which can it's like guaranteed income, the way the bank will then lend off it and make things easier. Yeah, and just the other thing to check with the tenant is just tenant arrears, payment history. That'll all come in the ledger as well. Review tenant compliance with lease obligations. Like, again, that's kind of where the overlap with legal happens. So you can work with your lawyer to do a lot of that stuff. But, we ask agents and we've got our checklists up front so we can actually then show the legal team the info we got. So it makes it a bit easier.
So broad brushstrokes then, the different bits of DD. So one will be tenants, another one will be like the title would be another one. And that's all covered in by your legal people. You've probably got the actual structure of the assets, building and structure will be another subsegment of DD, et cetera, et cetera. So finance is another major one. Anything specific around there you need to be clear on? Yeah,
so the financial checks we go through, we wanted to get, again, the statement. So, sometimes we send it off to an accountant just to triple check things because the ledgers are pretty hard to understand. And our team's quite good in that department. Again, like the background of our due diligence analysis guys are very financial based as well. Some are ex-valuers, accountants, all that kind of stuff. So yeah, it's a strength of ours. And that obviously can then help review the outgoings and council rates. And that's easier said than done because they all vary as well. And sometimes you just don't get this information through the whole process, but you've got a giveaway is whenever that agent submitted something, it says it's $3,000 per annum for water. It can't be $3,000. It's very unlikely it's a whole number like that. So you can then just drill down and get the exact numbers because it might be 3,256. And then we need that back out because that could, meant we've overpaid by thousands. It has a big impact on this stuff. But yeah, look, the financial analysis, the biggest part of it is really just working out, the verified yield of the property. And that's very hard to do. And then we got to go into things like, historic occupancy rates, very difficult to do, but, we've got years of valuations submitted to us, know where the market's going and appreciate the market is always changing as well. So rental yields and square metre rates charge a lot. Like, we were speaking offline, your office rates in North Sydney, like they're dropping in many areas. So like if you bought that property a couple of years ago, you would be pretty unhappy as an investor because you'd say, well, I looked at the comparable rents you submitted at that time, they're 20% down. Like, did we use rates that were higher than we should have? And no, you were just using what you had at the time. But markets do change the worse or better. But long term, it should always be for the better. But you're going to get blips in that. But yeah, that's rental growth trends, that comment. So again, a hard one to get through, but that's the analysis you need to do, is thinking outside the box.
Where would upside potential sit within the DD process? You would think your acquisition people sort of identify that, but to actually assess that would be, looking at development overlays, what can be done, council regulations. Like, is that would fall into DD with you guys, or is that something specific that?
Yeah. So something I've been drumming into the acquisitions team is everyone quotes upside, agents included, upside, upside, upside. Do not mention upside unless you quantify it. So you've got to, if the rents are under, sometimes the rents might be 20% under, but the yield's 20% below as well. So there's no upside. The upside's what the perception, you can increase rents, but we're already paying for the final price. So if anything, we're losing cash flow for the privilege of the market value later on. So we've got to quantify it. And the due diligence team then just needs to drill down into comparable rents, because it's very difficult to get the exact, like I was talking to someone in the office who were looking at like a tin shed and working out exact what that shed would rent for, because there was a few comparables on, tilt panel and what is the real difference between it. A lot of tenants don't value tilt panel as much as an owner-occupier would. So there's nuances to it as well, which it's not cut and dry, but that's, you just almost got to all work together to get the line in the sand where the value is.
But to identify structural uplifts. So, hey, you buy a suburban shopping centre and you can chuck on, there's a big car park, you can chuck on another 10 shops, right? Who works that stuff out?
Well, you can do it professionally by, employing developers to do, entire breakdowns of it, feasibility studies. I've done that on a few of my deals. I'm actioning one of them at the moment, which just involves basically increasing, we'll do a podcast on it as well because there's so much in it, but enclosing an arcade area and turning it into net lettable floor space. So that's been going on for a while now, but the delay was in the tenant. We needed a tenant to pre-commit to it, and that's when we can then show a material increase in the rent. Then it's worth taking the risk. I'm not going to spend $3 million on a what if. Like, I want a signed lease, and that's how you can do it.
And who negotiates? Are you negotiating it yourself, or you got the
property managers?
Property manager negotiate it. So it's a good property manager will be able to work that out for you.
They should, yeah. Similar to the podcast we did ages ago with Daniel. We was talking about a Woolworths lease. I think pre-commitment, leasing managed. So a lot of sales agents do leasing as well because it's part of getting the sale through. It also means they get paid in the dry periods because leasing deals are large and they're quite lucrative in commercial because, they could be millions per annum and, there's a leasing fee in that, which could be a lot. So they keep their hands dirty on that stuff. And, it's not totally separate like it is in residential.
So a good DD process will just give you an objective summary on the integrity of the asset that you're buying and should give you the sort of green light or red light on it.
Yeah. So you'll know if the tenant's paying. You'll know if the property's fairly valued. If you're buying something where the rents have upside or downside. You're buying in the right industry as well. All the legal stuff is super important, like the legal floor area, upcoming DAs. Like, you kind of understand the risk better. Like, due diligence is, again, the best due diligence is when you find out everything you already knew. And a lot of, some feedback, I've heard in the early days was, I already knew all this stuff. Okay, because it went perfect. The acquisitions team was spot on. The selling agent was completely properly briefed by his vendor, and the vendor was diligent enough to collect every bit of info and to supply it. That's when it all goes perfect. Due diligence is a safety net, nothing more. Like, we don't want to find, we don't want to find these problems, but we have to. It's non-negotiable because if we miss them, then that looks worse than anything, and it's definitely not worth putting a deal through that someone's got to then offload. But that's, it never happens.
Yeah. Okay. No, it's a good way to frame it. So burning questions, Scott, which and these are questions coming in from all over the place, largely through the Rethink social media feed. So if you've got any questions, can DM or you can do public questions around that. So how can home equity be used to fund a commercial purchase? Can it effectively secure 100% lend, and what are the risks? So this is really refinancing your principal place of residence.
It's common. I mentioned an extreme example of that was like we had a farmer client leveraged off a large 100 mil plus type acreage place and went 100% debt into a $34 million deal, but the deal was 9.5% net. His interest rate's below 6%, so he's making over $1 million clear just on the debt, 100% debt. So your interest rate must be well below, or even if it's 1.5% below the yield. So if you're buying a 7% yield asset, your interest rates, as long as it's like 5.5%, 6%, you're looking pretty good. So you just need slightly higher cash flow. But remember, the cash flow will grow on the commercial asset. So even if you bought something at 6, 6.5, every year you got rental increases, and hopefully that interest rate doesn't keep going up every year as well.
Okay, here's a good question. How do you graduate from $2 to $3 million commercial deals to 10 million assets? What needs to change in strategy, lending, and team?
Look, all of the above. It's basically selling down, refinancing, not taking action for a few years as well. Like that's how I did. I went quiet for about 2 years and I was saving money, and then the equity built. And rather than just impatiently going, because I was the most impatient investor of all time. I was buying every time I could, taking out personal lines of credit just to scrape in with deposits. And that's what a lot of people are doing again at the moment because they're seeing growth. The alternative to that option is once you've got an asset base worth talking about, you can then just do nothing and let the market hopefully grow, 5, 10, 15%, 20%, and then 20% of that, you leverage off 65% of that entire deposit. Could be a large number. You might have saved some money. You may sell off a bit and pay your tax and get out of some shares. Like just accumulate one large deposit, and that's generally how those bigger deals are done.
Final one, LVR in practice. So is 80% LVR sensible for assessing better quality assets, and does pushing leverage make finance approval materially harder? How many lenders are doing 80% commercial now?
Oh, I'm sure they are, but I'm not hearing much of it. Our clients are all pretty conditioned to do 70%. So I'm sure it's out there.
Which fundamentally changes your cash position straight away.
Yeah, exactly. And again, a lot of them are mature investors as well, where they don't want to redline anyway. Like, again, we've got the residential business, because if you've got a 5-10% deposit, residential all day, you can just make sure your job's secure and you're not taking too much debt on, and that'll improve in time. But if you're buying a multi-million-dollar commercial property, 30% down means you sleep pretty well.
Yeah. Yeah, something's got to go quite bad.
Yeah, even if you lose a tenant, you've got some cash flow buffers in there. Like it generally goes, you're never going to be forced to sell generally. Like especially if the market's growing, you might have 40% equity in the deal. So yeah, it gets easier with time as well.
I don't imagine you make these checklists available, because that's pretty much
and they keep changing.
They keep changing constantly. Yep. What I would say, if you're not using a buyer's agent, make sure your lawyer is a good property orientated lawyer. Not all lawyers are created equal, much like accountants. But Scott, if people want to sort of dial in and understand your particular way of doing this, what's the best way to track you guys down?
The commercial side, rethinkinvesting.com.au, and we can give you updates on your price point, because that's kind of what everyone wants to know. Like, what's the waiting list? What's out there? Like, you just talk to them about where you are at, and then the conversation's personable.
So realistically, how long will it, like someone goes, hey, I want to get going today, like before you sort of exchange and then settle on something? You're talking months and months, right?
Oh, yeah. It could take 3 to 4 months to settle on a deal, even if you've got a massive budget and there's a deal there right away, because, you're under contract for 45 to 60 days of that, assuming no extensions, and then you got to find the deal. You might look at 3 or 4 before committing. Could take a month or two. Like, it totally varies, I guess. Yeah.
Okay. Nice one. Well, thanks for your time. It's always good. Enjoy that conversation. Remember to check out rethinkinvesting.com.au. Thanks for tuning in. We'll see you next time. Until then, bye-bye.